So, good morning, everybody. My name is Kim Tucker, and you are at Mid-America Association of Real Estate Investors, or MARI's 2021 Market Update Market Forecast featuring Kevin Shortell. And we're really glad you're here. If we were sitting today in a hotel, this would be where I would give you the housekeeping rules of a meeting that's live, such as turn off your cell phone, which you might want to do. I probably need to do that because mine kept interrupting me yesterday. I point out where the bathrooms are and how you get out in case of a fire. So I'm hoping that everybody where you're at knows how to get out of wherever you are in case of a fire. I know a few years ago, I was at a training event with Kevin, and while we never got interrupted during class time, we got interrupted at dinner. We were in different hotels, but I was actually in a car at dinner with Michelle, and we got trapped in a hotel restaurant. And then they shipped us off to a Starbucks for an hour and a half, and then we got chased down I-70 or wherever the highway was back to our hotel by a tornado. And then we got called back out at 2 a.m. with another tornado siren. So I'm hoping that wherever you're at, you know how to get to safety. And if you hear sirens at my house while my mic is on, I have a fire station a block away. I have a police station a block away. I have a major highway a block away and a hospital a mile away. And I'm under the landing strip for the downtown airport. So I do have a lot of buzzers and bells. So hopefully there's no disaster on my part. It's just where I live. All right, well, cool. I have a few others. Housekeeping issues. Be sure to post your questions to the chat. Kevin talked to me earlier. He said he had a ton of information to go through, and he's trying to get it right through at an hour. So those that have to get off can. But if you have questions, he'll stick around after he's done to get the questions answered. And if there's any simple questions like what was that website or something that I can answer, I will try to make sure that we answer as we go. But if it's more in depth, we'll hold that question for Kevin. We are recording this, so I will make sure that everybody gets a copy of the replay. We will be posting it. If you go to our calendar of events and log in, we will be posting it to today's event on the calendar. And I know we have people joining us from all over the country that might be looking for Kansas City specific statistics. And I've got some links on my screen here that you might want. I will add them to the chat here in a minute. But KCRAR is the local realtor website, and they have a new website, and I'm not sure exactly where to send you, so explore. Mid-America Regional Council, mark.org, has lots of statistical data on just about anything you could get data on. They have that. And if you're looking more for commercial and apartment investing, I really like the Blocks as a commercial real estate agency here in town. I was able to find this morning Blocks Kansas City Market Report for 2020. I don't think their 2021 is out yet. But if you Google Blocks Kansas City Market Report, you'll find that, and they will ask you for an email, but it's usually packed with a condensed version, and they hit every real estate market. They give you an update on office buildings, warehouses, apartments. So if you're looking for that kind of data, check that out. But let's go ahead and get started as people are getting logged on here. I want to welcome Kevin to the screen here. Kevin, can you join us?
I am here. Can you see me all right? I'm still on?
I don't know when it was that we first ran into you. I know we saw several market updates that I'm pretty sure that you did over the years. That you actually wrote. And then I think it was probably at that tornado event was the first time I got to see you teach. So.
Oh, really? Wow. Well, that still was probably a long time ago.
So I've been a little bit at other events, but that tornado event, I think you taught the majority of the weekend. So.
Yeah. And yes, I've been compiling data, doing research, and providing state of the industry addresses for, at least 15 years for the industry. Yeah.
So, well, cool. Well, I'm going to welcome you to the screen. I will let you tell your story because I'm sure I would screw it up. And I know we don't want to sit here and listen to me chatter for hours. So I'm just going to let you take it away, and I'm going to unshare.
Okay.
And I am going to let you share. There we go. Kevin should be able to share. All right.
All right.
Cool.
Everybody see that okay?
Yes.
Okay, perfect.
Although we're getting your whole screen. There we go.
Excellent. All right. Well, good morning, everybody. Happy Saturday to you. I'm excited to be here. I love having people online that we can talk to and share this information. It always motivates me to continue to do research. I was even researching later last night about some key people in the upcoming administration changes and everything else. So I've got a lot of good information for you. I'm going to try my best to keep it at an hour. I'm a little over prepared for that right now, but if I have to condense some things, I can certainly do that for you, but I want to deliver as much information to you as I possibly can. And in addition to covering the industry at large, I also wanted to give you some things that you should really start to look at right now in preparation. So I've narrowed that down to 4 things. I have more than that, but these are 4 components that all real estate and real estate note investors really should start doing right now to prepare for this next year, because there is a lot of misinformation out there as well. There's a lot of knee-jerk reactions to things, and I've been monitoring this as I do every year. I constantly research what's going on in the marketplace, and largely I started doing that as a result of my failing to do that before the last crash. And when that last crash hit, we all should have really seen it coming. We knew it couldn't last, but it happened so quick. It happened almost overnight, it seemed, and the depth of it was more than I think what most people imagine. So I committed myself after 2008 and 9 to say, I'm going to focus on the market and keep up on it, on research and everything else, which I do on a regular basis here. So first of all, every year I've done this, which has been about the last 15 years. I do my best to do projections. I've been pretty darn accurate on those. And this year it's a little bit different, right? We've got a lot of things through 2020 and 2021 that we're looking at, all of which you're probably familiar with, which of course was the COVID-19, the amount of spending and stimulus money that the federal government is pumping out. State governments have come in and changed some rules and regulations, things like, the evictions and foreclosure moratoriums, that sort of thing. We still have, and it's getting worse, unemployment issues right now, again, largely as a result of the COVID. Corporate bankruptcies, Chapter 11s are up. Personal bankruptcies are not. We'll talk about that as well. A lot of people now figuring out we don't need to go to the office anymore. We can move in our homes, and that's causing people to move outward from the cities into other areas. So that's affecting real estate as well. The changing workplace. And of course, when are we really going to be able to start the economy back up? Because there's still a lot of people not working and a lot of businesses that may not come back. I know you're all familiar with this, but I want to kind of start with this because now we also have, of course, which we've had for the last several years as well, but all of the politics and the legislation. And I mention this because there's a lot of things that can change virtually our industry overnight through legislation and also through technology. So we have to make sure that we're on top of those things. So I'm going to cover a lot of things that are impacted by this. And again, I'll give you some guidance as to what I see in the marketplace, because there are, with all of this going on, there are some things that we know, and there are some things that we should focus on because they are factual. All the other noise going on, we need to be observant of. We need to study the marketplace at some level, but if we focus on what we can factually determine, it's going to help you guide through this next year. For example, when COVID happened and a lot of people lost their jobs virtually overnight, there were people in the industry projecting just a massive collapse. Things are going to be absolutely horrible. It's going to be worse than the last crash. And I was one of those voices saying, I don't know. I don't think that's going to be the case. It might be, but when the government can turn on that printing press, which they've done, and artificially keep things going, yes, in a way it kicks it down the can down the road. I get that. We'll talk about that. But I cautioned people and said, don't start to stockpile compile and retreat and just say, well, I'm going to wait until everything crashes, then I'm going to come in, because you may not see the type of crash that some people were anticipating. With all of my clients, we continue to invest because there are great deals in the marketplace. So I'm going to focus really on the note portion of the marketplace right here, but I'm sure many of you have found that in the more traditional bricks and sticks of real estate as well. And there's new people constantly entering the note industry, many of them from the real estate side, understanding that real estate notes is the financial side of real estate. It is real estate. So when you combine, they're kind of opposite sides of the same coin. Combining real estate, real property with real estate financing, the note business, that will give you more opportunities. It will lower your risk, and it will also yield greater returns for you when you do that. And that's what I encourage people to do all the time. And that's whether you're new to the business or advanced, by the way, because I've taken clients, I just want to show you some deals that any one of you could have purchased through this last quarter of the year. We were very busy all the way up through closings through December, and not stopping, identifying the market when I saw a lot of people just retreating, and they've missed out on some good opportunities, such as this. Let's see. There we go. Slide's not advancing. Here we go. Okay. Again, a $34,000 property, Cleveland, Ohio, a brand new investor, less than a month in the business, was able to purchase this for just under $20,000, making 15%. Now, again, on the note side, I know many of you are familiar, but in case there are people who are not familiar, in the note business, you get the cash flow, but you're not the landlord. Right? You don't own the property. The borrower owns the property. You simply collect the cash flow from it. You are the bank in that particular case. So you don't deal with all the same issues that landlords do as well. It's just a pure cash flow play on this one. So great deals. And part of the inventory that's available right now in the note business are very mature notes. These were notes that were probably non-performing back in 2009 and 10 that were purchased under non-performing, became reperforming notes, and now they're very, very well-seasoned notes. And when you add in all of the price increases that we have had, the equity positions in these, it makes them very, very safe investments, but yet, as you can see, high yielding. So there's a really good inventory right now of those type of notes for those who are interested in that. And they're all over the place. This one was in Birmingham, $94,000. She got this one for $25,000. So imagine investing $25,000. It's backed by a $94,600 home, and she's making 12% on her money. If property values go down, which we'll talk about as well, are you able to absorb any decreases in prices? Certainly in cases like this, our investors are. Here's another one in Illinois, 25,000. They purchased this, and what they got in return, it's basically in the note business, you're trading present dollars for future dollars. So they traded, if you will, they purchased, they invested $22,500. In return, they're getting 163 payments of $344 per month, which would, if you run that through a financial calculator, is going to tell you that's 16% per year. These are all deals purchased within the last couple of months of the year, and largely from investors who can't find inventory, or they're tired of the landlord concept, and they want to, at a minimum, diversify their portfolio. And some people are just starting to focus just more on notes in the current market conditions. And they go all over. I showed you some lower price band, by the way. I'll show you some higher ones. Yes.
Just to clarify, these are not, when you say deal, they didn't buy the house. They bought the mortgage on the house.
That is correct.
Okay.
That is correct. So again, we're in the note side of this. As I was saying, we don't own the property. The borrower owns the property. We are acting as the bank, if you will. We take over as the lender. So this person has invested in this. I don't have the price on that one, but he bought 118 payments, all the remaining payments of $386 a month, which is almost 16%. And his investment is backed by, the collateral is the property itself. So for example, on this one in San Antonio, the property's worth $120,000. He paid $57,000 for that note. very, very safe. If the person doesn't pay, worst case scenario happens, there's a foreclosure, he's going to get his money back. I mean, that property would have to dramatically drop before he wouldn't get his money back in something such as that. But with these very mature notes where people have a lot of equity, they would sell the house before it goes into foreclosure. So very, very safe positions. And there's a lot of that inventory out there right now. So I bring those up just to show you this is not a time to panic. This is not a time to retreat. It's a time to examine the marketplace and find these deals. Now, these deals aren't going to show up on MLS. They're not going to show up in foreclosure listings, that sort of thing. It's in the financial side of the business, which is another important aspect that we'll talk about. So the doom and gloom of everything, the knee-jerk reaction went to a very high level when COVID hit back in March of last year. In fact, Moody's was projecting. Now, Moody's, for those who are not familiar, they're a bond rating company. If you've ever seen the movie The Big Short, you know who I'm talking about. If you haven't seen the movie The Big Short, watch it. It's very, 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 very interesting. And they do a great job of explaining what happened behind the scenes on the last crash. Moody's was a big part of it. Okay. So Moody's in their economics department had projected back in March, April, May of last year, they said that we are possibly looking at 30% of all mortgages to go delinquent. 30%. Now, that may or may not mean something to all of you. So let me further explain what that means, because I was thinking there is no way that's going to happen. Because it does, there's going to be way, way, way more problems in this country than we've ever seen before. Because in the last crash, which is represented here on this chart, the 10% of all mortgages were in default. That's factual. We know that because that's historical data. That's what the peak was in early 2010, delinquencies of all mortgages. And now Moody's last year was projecting 30%. Can you imagine? That was the biggest bump back in 2010 this industry has ever seen. That is actually what put the note buying business on the map, because our inventory was massive. The prices were extremely low to buy these things. 20 cents on the dollar purchases were not uncommon at all. So that was historically the worst foreclosure, worst delinquencies that we've ever seen. 30% would have been just beyond crazy. And of course, it didn't happen. We are right now right there. So I put a little line there. I'm going to show you in a different chart in just a second here, but we're at 6.33% of all mortgages are currently delinquent, which is still significant. 10% was the worst that we've ever seen, and we're at 6%. So we do have a problem. Part of that problem is being kicked down the road because we're stimulating people with income, with unemployment, extra income, all those things that you all are familiar with. And we're also saying you can't foreclose and you can't evict on certain loans. We'll talk about that as well. And if you can't foreclose because of these forbearance plans that are going on, you also have to, by the way, under the CARE Act, report that those loans are current. So you have to be very careful when you're looking at mortgage data to see if they have included the ones that are actually delinquent, but declared with credit and everything else as current, because that was a part of the CARE Act. Let me take this chart and show you just a little different perspective of it. This is the delinquency rate that you can see once again peaked in 2010, 2009 towards the end there. And now we are over on the right-hand side of your screen where we saw a spike. And now that spike has come down a bit to 6.44 in November. And the very latest numbers, which I put together last night for you right here, are 6.33%. So that's the latest data that has come out that's reflecting back on November. It takes several months for this data to get compiled here. So that's up 79% year over year. It's not the 10%, but it is significant. Now, why that's important to you as a real estate investor and or note investor is this. One of the other numbers that you're going to see on there, which I'll spend a little bit more time on later on, but I want to highlight it here, is the number of foreclosure starts. Nationwide, there were only 4,400 foreclosure starts in November. nationwide, 4,400 foreclosure starts in November. The existing inventory of pre-sale, what they call pre-sale foreclosure inventory in the United States, 176,000 homes. There's a big reason for this, and it really goes all the way back to Dodd-Frank. Banks have been getting away from massive foreclosures since the Dodd-Frank Act was approved in 2009 or 10. And the reason they do that is there's penalties built within Dodd-Frank that puts pressure on banks to get those delinquent loans off of their books. They can be penalized up to 10 times. Now, I'm not going to go into all the details of that. I'm trying to keep this on focus here, but that really changed the foreclosure market virtually overnight, because what banks figured out is I've got to get these bad loans off of my books now versus going through foreclosure, which might take them over a year. And what they started doing was bundling up all of these non-performing loans and selling them. They can sell them at an auction and be gone and have them off their books within a month, versus paying penalties, severe penalties, and keeping them on their books by going through foreclosure for a year. So there's been a dramatic shift on that, which obviously affects real estate investors who are looking for deeply discounted property. Your inventory, and you've probably all experienced this, your inventory level has shrunk on those types of properties. Why? Because the bigger lenders are getting away from that, and they've really shifted to more of a note transaction. They'll bundle up the notes, billions of dollars per month, and I'll show you that later, and just sell them, and they're finished with them. Okay, that's a dramatic shift that a lot of people are not aware of in our marketplace, and need to be, because how you work your business around that is very, very important to you. So again, another little chart here, and then I'll move on. But you can see that spike once again, and you can see in 2000, in the second and third quarter, is when things started to go up again. This is creating future inventory for real estate investors, but not in the foreclosure market. The future inventory opportunities from this spike is going to be in the financial side, which is the note business, because these properties will never go through foreclosure. They'll be bundled up. The notes will be bundled up and sold. That's where you're going to find those opportunities, not at the courthouse, not at the pre-foreclosure market, because you won't see that. Okay, that's a change in the marketplace. Now, I know I've spent a good amount of time on the same topic here, and I have a lot of things to get to, but it's very, very important topic, and illustrated by CoreLogic. Now, CoreLogic is a big company, national company, and they're one of the sources that I use for all of this data. And you'll notice I do source everything here, but I want to point out some things. I know there's a lot on this slide. I cut and paste right from their latest report, economic reports that came out. And what I want you to see, and I'll highlight it here, is as they track this data and they saw the spike going up, which I showed you in the chart already in April, and now it's come down a little bit, they went back and looked at 2008. And what they saw in the mortgage-backed securities, you can see it there, is, interestingly enough, in 2008, in April, there was a spike in 30-day delinquencies. In May, there was a spike in 60-day delinquencies. In June, there was a spike in 90 days delinquency. And that's when people get on that slippery slope. When people get to 90-day delinquency, the percentage that will ever get current again just falls off. There's nothing there. 30 days, they can catch up. 60 days, a lot of them can catch up. 90 days, they're not going to be able to catch up. And that's when it gets worse and worse and worse, and eventually foreclosure or loan modification or deed in lieu that will come into place here. So what we're seeing in 2020 was a reflection, really month to month, of what we saw in 2008. And that's why CoreLogic is projecting that we could see as many as 3 million homes in serious delinquencies, that's 90 days or more, serious delinquencies, by the end of 2021. That is very, very significant to all of you. But once again, that inventory, if that happens, those 3 million homes, that's not going to be in the foreclosure arena. It's going to be in the financial side. Why? Because banks will not keep those homes on their books and go through foreclosures, because it's too expensive with all the penalties on there. Okay. So imagine you have $1 million worth of non-performing notes on your books as a bank, and the Fed is saying you've got to hold $10 million 10 times in cash reserves. That's too much of a penalty. So what do? Get them off my books. Those will be sold, and there'll be a funnel where these notes are sold on auctions. It'll go to big companies. Those companies will break them into smaller pieces, and that'll trickle down to individual investors in certain markets. Okay, so this is going to be a bit of a repeat, albeit smaller than what we saw in 2008. And CoreLogic tracks this on a monthly basis. They put out monthly reports, and they have a very good blog system and everything else. What's been holding a lot of this back already has been the CARE Act, right? So the CARE Act is the one that said you can't foreclose, you can't do this, we're going to provide stimulus, we're going to do this. And that relief bill was signed into place. Now, some of that was set to expire in December 31st. Many of you are probably familiar with this, but they have extended this already, the foreclosure and REO evictions through January 31st, 2021. But the way they wrote it, and this is right from the Federal Housing Financial Agency, is until at least very high likelihood that this is going to get extended. To what point? Now, not all landlords are going to be affected by this. Not all note owners are going to be affected by this. These moratoriums are the ones that are backed by federal money, the enterprises, as they're calling them in this article, Fannie Mae and Freddie Mac. Okay, so when this paper is traded and the government backs all of these loans that the banks are doing, and non-banks, by the way, to a high degree these days, those type of loans automatically fall under these categories. If you're a landlord who has borrowed money and that borrowed money is backed by Fannie and Freddie, you can't do evictions on there. Now, in addition to this, some states and counties have enacted their own moratoriums. So this is a bit of a game changer, especially for landlords. I would bet anything that there are some landlords right now on this webinar that are going, yeah, I've got people who are not paying rent. I've got this and that happening. And part of it is public perception. In our business, if I do a seller finance loan to somebody, none of this applies to me, right? None of it applies to my borrower. I'm not backed by federal money, right? So I can still foreclose, I can still evict and that sort of thing. But in my world, it's more of a foreclosure. I can still do that if my courts are open. And that's what happened here where I live in Central Florida. Our courts just said, we're not taking these non-essential actions, judgments anymore. So for a long time, even though I had a right to foreclose, I couldn't do it because of the local courts. So we have to look at both. We have to look at the federal level. We have to look also at the local level. One thing that has really been working for us, and this is significant to you as well, because this is the proof that you're not going to see some huge crash. Okay, it'll be a degree of a crash because the CARE Act forbearances has worked out pretty darn good. So we had a total of 6.48 million people apply for forbearance, and they could apply for 180 days, and they could reapply for 180 days, and then it got extended, by the way, to 12 months. Okay, so what's happened since then? Well, as of November 2020, out of the 6.48 million of people that got into forbearance plans, now just to make sure everybody knows what a forbearance plan is. If you're a borrower and you're making payments on a loan, and again, federally backed a loan, you had the right to file for forbearance because of COVID and the CARE Act and the CDC and everything else. And what that meant is that you don't have to make a mortgage payment for 180 days. And then you could reapply for another 180 all the way up to 12 months. And essentially, if you asked for it, you got it. Now, there are some little things in there I could talk about, but let's just stick with that. And that's how this worked. First of all, having people make no payments, I think, is a big mistake because they get in the habit of not making payments. And I told all of my people, I said, look, if you have a seller finance loan or you purchased a loan, private loan, and you're going to give somebody some relief, that's fine, but don't make it where they're making zero payments, because guess what? They like that. They're going to stay in that habit, and it's going to be very difficult for you to get them going again. Work with the people. If their payment's $600 a month, but they can afford $4, have them pay $4. Don't have them pay nothing. So these folks didn't have to pay anything on this, but the results now that have panned out are pretty impressive, I have to say. So you have on the lower left, 35% of the people who entered this, 35% of the 6.5 million people, they got their term extended. That's where we are right now as of November 17th. But 39%, up in the upper right-hand side there, 39% have been removed from the program or it's expired, but you'll notice it's performing. So 2.5 million people who had forbearance protections, that program either ended or they voluntarily removed from that program and they're continuing to perform on their loan payment. So the stimulus programs and these sorts of things have impacted this to a great degree, is what the experts are indicating here. Just underneath that one, it says removed, expired, and delinquent. But active loss mitigation, what does that mean? So the 7% there, the 434,000 people who are in that program, their forbearance plans expired, okay? But they still weren't able to perform. The difference here is that they're under loss mitigation, meaning that the lender is working with them. Okay, there's a reason for that, and I'll talk about that in just a second because this is a very different crisis than what we had in 2008. Okay, it's important to know the difference there. So banks are working with these people. Big reason is there's equity in the properties today. There wasn't in the last crash. Removed, expired, delinquent. So 2% of all the 6.5 million people, only 2%, their plan expired and they're continuing to be delinquent. That's pretty small number. Interestingly enough, 9% of the loans were paid off. People are in forbearance. They came up with the money and paid off the whole loan. And then you can see the active forbearance original term. They're still under the original 180, 360, whatever it was plan at this point in time. So again, the big difference in all of this is there is equity in properties. And when there's equity in properties, lenders can work with you. If you go back, for example, in the crash 2008, we bought a lot of loans where the property was initially worth $200,000. Now it's worth $100,000, but the people still owe $180,000. There's no equity in that, and you can't. It's very difficult to work with borrowers when you have that. When borrowers have equity, then there's more willingness for banks and bigger lenders to work with people. Now, that growth rate, as you can see, is slowing, which means property values are starting to peak out, which shouldn't be a surprise to everybody. We've had tremendous growth in property values since 2010, but now they're starting to peak out. In fact, many experts are looking at key markets, and the property values are way, way, way above what they were in the last bubble. So there's a lot of speculation that we really are already in a bubble for that. March is going to be an interesting month with all of this forbearance, because in March, you'll see that 26% or so of the active forbearance plans, those expire. Okay, so the 12 months plans, we didn't have that much in January, and that's why the numbers, which I'll show you again in just a minute, they didn't change that much. But in March, it's going to be a big deal. And we'll see what happens April, May as to, are these folks able to make the payments again or not? And that'll be an indicator. Are we going to hit that 3 million of severely delinquent, or are things going to kind of smooth out just a little bit here? So foreclosures is not where the marketplace really has moved to from the lender side. It's gone over to packaging these notes and selling them. And to give you an example of that, by the way, this sale, I just pulled this last night. This was the 18th overall, but fourth sale that Fannie Mae did. Now, Fannie Mae is just one entity that does these sales, but they're the easiest to track and look at. So I just pulled that. They had in October, they sold 6,300 loans with a principal balance of 734 million. The sale before that was 8 billion, by the way, or I'm sorry, over the year it was 8 billion. My apologies. So it was a couple billion the month or two before that one. So this was a relatively smaller sale. But my point is just showing you what these entities are doing. When banks create loans, they really sell the paper to Fannie Mae. And when those loans go bad, they're looking to rework those loans. That's what reperforming is. But if you read into the article, some of these loans may be up to 90 days delinquent. They're not performing. Okay, they're at that slippery slope right here. So Fannie Mae is not as active of taking these properties and selling the properties. What are they doing? They're bundling the paper and selling the paper. Okay, that's what eventually trickles down to us, where we can buy non-performing and reperforming loans. Okay. Bankruptcies is another issue. I know it's kind of a hard shift here from that topic to another one, but in bankruptcies, it's something else that has been an interesting thing to track here. Personal bankruptcies have gone down quite a bit since 2011. In the crash of 2008, 9, and 10, you can see over a million people had filed bankruptcy, and that has dramatically fallen off, and it really dropped down in 2020. Experts are projecting that this number may go up. Why? Because many landlords are not being paid, but they still have the right to sue for that money. So there's an expectation that there will be some lawsuits that are going to be filed on a national basis, which will increase the number of bankruptcies. Now, what importance does that have to a real estate or real estate note investor? In the real estate note business, we look for bankruptcy notes. We can we can make a very good profit. We can get free money in bankruptcies. We can work with the consumers to keep them in their homes and still make it very, very profitable for us. Again, a bigger topic here, but so I'm just kind of highlighting it for you. But bankruptcy can be a big deal for a note investor. We pursue those types of deals. And I've got case study after case study that shows you why ultimately that we do that is because we can get free money in addition to the regular money on a workout modification. So it's one of these things that you keep an eye on and look in the marketplace, because most real estate investors shy away from bankruptcy. Okay, because they're on the equity side, we're on the debt side. And with us, we pursue those. So I'm looking to see what the opportunities might be in for that arena as well. Okay, so focusing on what we know. Loan modifications, forbearances, foreclosures, and bankruptcies are absolutely going to be a part of the outcome of the current market condition. We know that. That is factual information. I just basically outlined all of that for you over the last however many minutes I was talking on that topic there. So action plan, I would say number one, if you're not familiar with loan mods, forbearances, foreclosures, and bankruptcies, get familiar with it, because it will be a part of what you're doing in the real estate industry, especially if you're in the note business. Doing proper modifications. Do we have to be concerned with Dodd-Frank? What can we do? Do we have to rerun credit? Do we not have to rerun credit? If we do a forbearance, can we add that in? Can we smooth out the loans? There's all sorts of things that we can do. And if you're not sharp on that, and foreclosures of what's going on in your local area, what might be going on in other states you're investing in, and what happens if people go into bankruptcy. If you're not familiar with that, you need to be. Why? Because that's coming. That's going to be a big part of what's going on in 2021. The government programs are really starting to push loan modifications. They want to work with the borrowers. No administration wants to see millions of people lose their homes, right? So study up on those would be a great idea for you to do, real estate and real estate note investors. Here's another good one for you. Let's talk about this. The prices on real estate have been going great since 2010, right? And if you've been investing in real estate, if you have rental properties, I'm sure that you've seen great appreciation in those. What about affordability, though? So we can see the median sold price of existing homes has continued to go up. Now, this is on a national basis, right? All real estate's local. Your prices may not be that. They're certainly not that in Central Florida where I live, and they're probably not out there in most areas of Kansas and Missouri, where most of you are. But nationwide, this is an overall trend. And when these overall trends happen, the government takes notice of this because they're thinking in terms of affordability. We've had an affordability crisis in this country for many, many, many years, and it continues to grow because again, medium home prices, they've outpriced what people can afford. And it's more challenging to get loans today. So when you look at these key areas, it opens up, well, there's an opportunity there. Okay, if this is a problem, what's the solution? And maybe I should focus some of my efforts as being a part of that solution, because problem solvers make good money in this business, right? Every real estate investor, essentially, you're a problem solver. Every note investor, essentially, you're a problem solver. So identify the problem, come up with a solution and apply it, and you're going to do very well. So, of course, as property prices are going up, you're seeing the supply go down, right? Naturally. So there's more competition. But again, affordable housing has been out there in the forefront for many, many years. And again, with Dodd-Frank, banks don't do small loans anymore. They can't afford to. They lose money. In some states, if a bank, because there's state law that affects also in addition to some of these federal laws like Dodd-Frank, in some states, a bank can't even do a $100,000 loan and make money, because Dodd-Frank limits how much they can charge to originate a loan. So these headlines are really, really easy to find. And Bank of America, for example, you can go right on their website, minimum mortgage, $75,000. That's it. Okay. They don't go below that. Why? Because at 75 grand, they're breaking even. That's really where they are. They're at break-even point on that, but they have to provide that type of loan because of the Neighborhood Stabilization Act, et cetera. So anyhow, it's difficult for affordable housing because people can't get loans. We can provide loans. We can buy those properties cheap. We can provide those loans. That's a solution. Okay. And that's something that all of you should really take a look at, because that's going to continue to grow, especially when I tell you about a person in the Biden administration you want to pay attention to and see what they're doing. I've been researching a lot on him lately. Okay. I mentioned this is a different crisis as well, and this plays into this as well. This is called the mortgage credit availability index. And without having to go into what it does and how they calculate it, there's a baseline you can see on the bottom as 100 for statistics. But let me just point it out this way. Back in 2005, 6, 7, how hard was it to get a loan? It was very easy, right? That's where we had the no income, no statements, no doc loans. We had pick a payment loans, 110% financing. It was very, very liquid. So what this index looks at is how easy is it to get a loan? How loose is the monetary policy? And you can see we got absolutely crazy in 2005. Everybody could get a loan. You know, you had a pulse, you walk in a bank, you get a loan, right? We remember those days. And of course, we know what happened. The big crash followed that. And then lending tightened up. Right? New rules, new regulations, new legislation coming in. And we drop back down to that baseline where it was more challenging to get a loan. Okay. Then by 2013 and 14, they started loosening the purse strings up a little bit, tweaking with what kind of credit score, what kind of down payment do people need, that sort of thing. And it started a gradual climb, as you can see on this indicator. And then all of a sudden in March 2020, it dropped down again. Why? Things tightened up. And again, of course, we had COVID and everything else. So I'm going to take that portion of this chart and magnify it for you. And what we saw is a 30% drop in the mortgage credit availability, which means it's more difficult right now to get loans in general. Okay, that's all that means. But there's several groups that are more impacted upon that, which again is a problem that you can provide a solution to. So what is that? Borrowers with lower credit scores, much more difficult to get loans these days because, again, banks don't want to take on bad debt right now. They've got enough, right? They understand what's going on in the overall economy. When are we starting again? People aren't making money. What if the stimulus stops? What if the extra unemployment stops? What's going to happen? So they're pulling back a little bit, increasing the required credit scores. Higher end loans are affected as well, by the way. Jumbo loans, harder to get. They're not doing jumbo loans over 700,000 in most places now. They've lowered that further down because they don't want to get these big loans. Mortgages with higher loan to value ratios, meaning you put smaller down payments. Those are tougher and tougher to get these days as well. Adjustable rate mortgages, Fannie Mae announced that they're not buying them. So if they're not buying them, banks aren't going to create them. So there's no adjustable where you can start low and build up. And then finally, non-qualified mortgages. Okay, we used to call those subprime, right? The subprime days. Those where anybody could get a loan days. They changed it over to non-qualified. Essentially means the same thing. A lot of the non-qualified loans are also done by non-banks. Non-banks are not under the Neighborhood Stabilization Act. And without getting too far off track here, what that means is non-banks don't have to set aside money for affordable housing for lower income. They don't have to do that. If bank, like a Bank of America, is lending in a certain area, they have to make a certain amount of money available to lower income, moderate income people. They have to do it. Okay, even though they take a loss on originating those loans. That's why they've retreated from that. A lot of banks are looking at credit cards and business loans and things like that, and they're letting the non-banks. Non-banks in the United States for years now do more loan originations than banks do. And they're not under the same guidelines. So non-qualified mortgages by non-banks, the non-banks don't have to give them in affordable housing areas. Once again, that's an opportunity for us because we can do those loans. We can create them, okay? Where banks aren't doing that. So there's going to be a big play within this and also in opportunity zones. That's coming up as well here. So once again, what do we learn from this? We'll focus on what we know. Historically, seller finance loans always fills the void left by traditional financing. So if banks aren't doing the low loans, if non-banks aren't doing those loans, we have a huge problem of affordable homes. Where are people going to live? They need financing. We can fill that void with seller financing. Hope that makes sense to everybody. So that should be a part of what's on your radar screen of providing that type of housing. Now, traditionally, some of you have probably done that through rental properties, but again, what's going to happen in the future with landlords? Is this new administration going to be landlord friendly, pro-landlord, or maybe not so much and more pro-tenant? Who gets paid first? Equity position, debt position. These are things you need to think about, and I'll talk about that a little bit more in just a minute. So action step number 2, start selling properties with seller financing. Even if you have existing tenants, convert your tenants over possibly. Again, I think a lot of you would take a look at your portfolio and say, you know what, I'm going to at least take this many, create these folks into property owners, get away from tenants here. And again, maybe you keep some as tenants. I'm not one of those investors who says everybody has to do notes and that's it. No, notes is simply a part of real estate, but look at your portfolio and see if it makes sense to convert some of your tenants into property owners, removing yourself from that role, but still getting the cash flow with that property. And then you don't have to worry about such things as evictions and all of that. You're now on the debt side of things. For those of you who are buying real estate inexpensively, where you can turn around and sell it, I'm going to encourage you, instead of just buying a property, fixing it up, and just selling it for lump sum, run numbers that show, what if I seller financed it for somebody? You know, what if I went direct to a consumer and sold the property and created a note instead of just getting that lump sum? What would that look like? And I'm encouraging you to do that because I think many of you will see, you know what, maybe I should seller finance this one. Especially when you understand that when you create a good quality note, it has a market value. You could create a seller finance note for somebody. And I know the concept here. A lot of investors go, yeah, I can't do that because I need to cash out. Well, what if you could create a note in a way that's so marketable that you could create it and turn around either right away or 3 months down the road and sell a part of it and get all the money that you need? See, that's a game changer for people. And then have that back end of the note. Best of both worlds. You get all the money that you need out of that deal, lump sum, but then you own payments into the future, which also have a sellable value. Okay. So that's what I mean by there's techniques here that you can apply as a real estate investor with the finance side. It just gives you so many more opportunities, so many more ways to make a return on investment. And it actually lowers your risk because we don't absolutely know what's going to happen in 2021. There's some factual things, but there's also a lot of things that can dramatically change. And if you have both sides of the coin in your toolbox, you'll be able to adapt to those a heck of a lot better than just keeping the blinders on, saying I'm just focused on long-term rentals, or I'm just focused on flipping properties. So start selling with seller financing, especially affordable housing. Why? Because that's where the opportunity is right there. I've shown you that. Home space, and build relationships with investors who are creating notes. One of my newer clients, he's from South America. He's been in the country for 2 years, got started with me in the note business, Leandro. And he was looking at some notes that I was helping him with in my consulting sessions. And I said, look, this person knows how to create a good quality note. They know how to borrow money to buy a property. They fix the property up. They sell it with seller financing. They pay off the underlying loan. They know what they're doing. Their paperwork's immaculate. I went through the whole deal. I said, this is an investor you need to build a relationship with. He's now bought 4 notes from that same investor. All right. He's his go-to note buyer when this investor creates it. So there's all kinds of ways you can do these sorts of things. All right. Shifting gears into the rental space here. Again, doom and gloom articles came out, May, June, July, 40% are at risk. It's continued, everybody. 40 million. Look, this just came out. I just pulled this article last night. It came out actually in December 11, 2020. CBS News, up to 40 million Americans could lose their homes if Congress doesn't act. It's just, that's just so blown out of proportion. It's absolutely ridiculous, and it scares people. Okay. So we have to drill down to the facts. Now, this is a harder number to figure out here. But there was a study done, and they looked at 11.5 million apartments that were all professionally managed. It's a sample. It's not a direct reflection of the entire market. That's a very small sample considering all the tenants that are in the United States. I get that, but it's the only way that they can do it. So the experts all the way through the government, this is a study that they looked at. And what they found was, believe it or not, 93.6% of the rents are being paid by the end of the month. Now, this is based on, again, 11.5 million apartments. This is not a big global, this is a sample, statistical sample here. So your experience might be completely different. I'm just delivering the facts of what they have said here. So what they do is they look at this statistical sample, and then they project that within the entire industry here. And that could mean that over 3 million renters could be facing eviction. Okay. Still a big number. Okay, but certainly nowhere close to the 40 million that they're projecting on that. But again, if you're in the rental space, you've got some alternatives there. You can convert to tenants. You could then do loan modifications. You could do evictions, or again, you wait and see what the administration is going to do. So be aware of that. It's not the sky is falling. It's obviously a concern. But again, that's just a statistical sample of, there's estimated 107 million tenants on there. So you can look at those studies. So a couple of things that you need to think about. Will property values continue to rise? Well, I've shown you that the equity positions have leveled out. And that's an indicator that property values are reaching a peak. Again, all real estate is local, but on a national basis, it looks like things are starting to peak. If things get worse, are we looking to see worst case scenario? Property values dropping. Now, all of a sudden, people's equity is starting to be diminished. Are we going to start up the economy again? Are businesses going to come back? There's a lot of things in question. So as you're investing, you have to think in terms of, could I absorb a 20% drop in property values? Could I absorb that and still be okay? And that's something that you would need to look at in your own portfolio. Again, I encourage you to look at the note side if you're not in it already, because who gets paid first, by the way, when things go bad? Debt owners or equity owners? Always debt owners. Always debt owners. And that includes in the stock market, right? If a company goes belly up, who gets paid first? The debt owners, the bondholders get paid first, right? If there's any equity after that, the equity owners get paid. In the real estate, same thing. If we own the debt on that property and things go worth, that's our collateral. Okay, we get paid first. Other lien holders behind us don't get anything, and equity owners don't get anything if it's worst case scenario. So if you've got portfolio of just real estate, it may again be time to start to look at, maybe I should start to diversify a little bit more. If you're new to the business and you're looking at getting involved in real estate and you're new to the whole concept here, again, do the same thing. Look at the note side, weigh your risk, look at the equity side and all of this and work accordingly. But I think diversification is going to be the key here. Oftentimes the cash flow can be more predictable than appreciation. Okay, because there's a lot of things that we can't control with appreciation that happen on a more national basis, where cash flow has a tendency to be more localized with the borrowers that we work with. Okay, so good. We're in good shape here. Take note of this individual. Okay, Jared Bernstein. Okay, Jared Bernstein was the keynote speaker. As you can see, this is just a snapshot from the National Association of Realtors at their December 2020 Residential Issues and Trends Forum. Jared Bernstein has been a chief economist advisor to Joe Biden since he was VP. Okay, many of his decisions in the Obama administration were played out. It says here on their keynote, likely appointment, he was appointed. And not only was he appointed, he's going to run that council. So this is an important person that has the ear of Joe Biden. And there's some things that he talked about at this forum that should pique our interest, of something to look at and continue to monitor, because a lot of what Jared says, that ends up happening. Okay, so you can Google search him. He's got a blog. The blog's a little stiff, if you will. It's a little boring. He mostly talks about the economy right now, and he doesn't contribute that much, but he does enough articles and things that you can read about and get an insight. So what I started doing was going back and saying, okay, what did he do? What were his ideas in the last crash? Because it's likely that if he liked those ideas then, he might like them again here. And he's got the ear of the incoming president, right? So what did they talk about at this? A home buyer tax credit of $15,000 at the closing. That's a nice incentive for people to buy homes, that sort of thing. So hopefully that increases people buying, but we still have a supply problem. That's not going to help the supply problem, but it is a motivator for people to look at homes. They're talking about expanding the 1031 exchange. I hope that includes from real estate to notes. Don't know if that will happen, but it's something to keep an eye on. They're increasing the type of properties that you can exchange for. They talked about re-examining Fannie and Freddie's role in all of this. They always do that. That's always a topic. And again, if you're not familiar, Fannie Mae, Freddie Mac, they are the big secondary note buyers for our lending industry. When banks originate loans, 90% or more of the loans they originate, they sell to Fannie and Freddie. Most people don't see that because the bank maintains the servicing rights. You're still making the payments to the bank, but the bank already sold the paper. Right? Lenders are in the paper business. Banks sell their paper at a discount to Fannie and Freddie. That's why when there's a foreclosure, you see the bank foreclosing at the very end. They do an assignment of foreclosure position, and then Fannie Mae has those assets on their books, and they either sell those or they sell them before they get to that point. They also talked about Biden's going to have, or at least he's going to advise Biden to have a looser monetary policy. That means that credit availability index we were talking about, look for that to go up. Look for new loan programs to come out for people. And again, this can affect a variety of different ways for people in the real estate business, but expect to start to see probably within the second quarter for sure. I would say you're going to see some new loan programs that are available to people. So that should be interesting to play out. Possibly extend the mortgage forbearance. Okay. Now, again, this is on loans that are backed by the enterprises, Fannie and Freddie. This is not seller financing. So if I do a seller finance loan, I am not under any obligation to do a forbearance at all. It's a private loan. I want to make sure that we're very, very clear on that, just on the federal level here. But again, what's going to happen? Are we just going to continue to kick this can down the road and build up another bubble, which will eventually crash? At some point in time, people have got to stay, they've got to pay to stay. Okay. So it'll be interesting to see what they do on that. I'll be keeping an eye on that. They talked about affordable housing. This guy's big on affordable housing. If you Google search him, he's talking years ago about the crisis of affordable housing. We need more affordable housing. You'll also see articles where he's talking about opportunity zones and how they want to change those and envelop some of the affordability within that. There's going to be good opportunities in here. And again, if you're able to purchase homes in those areas and offer financing, you've got the best of both worlds. There's going to be a lot of money to be made in that area. The scary part they talked about was the temporary lockdown of the overall economy. And again, if that happens, there's got to be more government spending, because people aren't going to be making any money. Businesses are going to have some problems there, and that's going to affect real estate. So that's why we have to prepare. Can we absorb in our portfolio, or the loans that we're going to be buying, or the real estate we're going to be buying, can we absorb a little gut punch? Can we absorb a drop in those prices? And I would get ready for that. Another thing that I'm hoping comes back, and it may, because they've done with, I thought I had it in here. You all should know that there's rental. I got it on the next slide. That's why. Okay. We'll talk about rental subsidies in just a minute here. But what I'm hoping is, he was a big proponent of something called hardest hit funds. Now, Michelle and Kim and all that, they know what hardest hit funds is all about. If they reenact the hardest hit funds, which expired at the end of December 31st, 2020, they could open that program back up again if we start to see these non-performing loans come into play. So on that projection, I gave you a core logic where it's showing potentially 3 million homes in serious delinquencies. One of the programs that they put in the last crash was called hardest hit funds. And in hardest hit funds, they pay the note holder a lump sum to prevent a foreclosure. Now, back then, if a house was worth, let's say, $100,000 and the people owed $80,000, and you bought that note for 25 grand, non-performing, and they applied for hardest hit funds and they got approved for hardest hit funds, which you pretty much know what the approval is, and if they can do it, what's their income, et cetera, et cetera. Some states were paying you $40,000 to catch people up on their loan, what we call the arrearage account. Doesn't matter that you only paid 25 grand for the note.